Market rattled by uncertainty, fear, and relentless short-term volatility, there lies a rare opportunity. Three AI infrastructure giants temporarily overlooked but fundamentally positioned to dominate the next phase of technological evolution. We're heading into an AI-powered future, and the companies that build and supply the infrastructure for this future are not just investments, they're essential components of the global economy. In this video, we'll break down three such stocks that have been shaken in the short term but are undeniably poised to lead over the long haul. Let's start with one of the most critical and underappreciated names in the AI race, Taiwan Semiconductor Manufacturing Company, ticker symbol TSMC. When market-wide sell-offs and geopolitical tremors hit, world-class companies like TSMC often slip under the radar and into deep value territory. But underneath that temporary market pressure, the company remains structurally flawless. TSMC isn't just another chip maker, it's the single most important company behind the AI hardware revolution. Without TSMC, names like Nvidia, Apple, and AMD can't produce their most advanced processors. And yet, due to near-term shocks like tariffs and macroeconomic jitters, this titan is trading at what many analysts call a discount. In the first quarter of 2025, TSMC generated over $25 billion in revenue, with its cutting-edge 3nm chips already contributing 22% of wafer sales. The 2nm process is set to launch later this year, pushing the technological frontier even further. This isn't just progress, it's dominance. TSMC is already planning to roll out 1.4nm chips by 2028, ensuring that global tech giants, Apple, Nvidia, and every major AI firm will be lining up with blank checks in hand. Despite a short-term slowdown in smartphone demand, TSMC's AI-related chip revenue is exploding. The company expects this segment to double in 2025 and grow at a compound annual growth rate of over 40% for the next 5 years. That's not hype, it's math, backed by a global AI arms race and hundreds of billions in infrastructure investment. With $81 billion in liquidity, a fortress-like balance sheet, and unrivaled pricing power, TSMC isn't just weathering volatility, it's future-proofing the entire AI economy. Tariffs may sting temporarily, but long-term, this stock is a bedrock of the AI infrastructure boom. As Warren Buffett reminds us, volatility isn't the enemy, it's the opportunity. TSMC offers investors a rare chance to own the backbone of the AI ecosystem while it's still on sale. Now, onto our second AI infrastructure leader, Micron Technology, ticker MU. While the spotlight often shines on flashy AI software and LLM breakthroughs, the real horsepower behind it all is memory, and Micron is leading that charge. After a rocky start to the year with a 24% dip from January highs, Micron came roaring back with its latest earnings beat. The company reported $8.05 billion in revenue, up 38% year-over-year, with earnings of $1.56 per share, beating estimates by nearly 10%. What's fueling this comeback? Two words: AI memory. Micron's high-bandwidth memory, HBM and DRAM segments are on fire. HBM shipments rose 50% quarter-over-quarter, and DRAM revenue surged 47% year-over-year, now making up over 76% of total sales. In short, Micron is no longer just a player, it's a leader in the AI memory arms race. As hyperscale data centers demand faster, larger, and more power-efficient memory modules to fuel AI agents, LLMs, and autonomous systems, Micron stands out as the only company currently delivering low-power DRAM for data centers at scale. And there's a major catalyst on the horizon. Apple's iPhone 17, slated for September, is rumored to upgrade its DRAM from 8GB to 12GB. This could meaningfully boost Micron's mobile chip revenue just as smartphone demand rebounds. Analysts now forecast a 51% upside over the next 12 to 18 months, with the HBM market expected to grow more than tenfold by 2034. While the NAND segment remains under pressure, DRAM is where the action is, and Micron owns the fast lane. In a market paralyzed by short-term fear, Micron offers what truly matters: solid fundamentals, long-term tailwinds, and a compelling valuation. Finally, we turn to our third stock, Marvell Technology, ticker MRVL. A company that's been punished for short-term guidance but quietly delivering one of the most asymmetric upside stories in the AI ecosystem. Let's face it, Marvell has had a tough stretch. The stock dropped after management chose not to raise its fiscal year 26 AI revenue target, even though it beat its fiscal year 25 AI goal by a wide margin. Investors wanted hypergrowth, and when they didn't get it, they sold off. But behind that reaction lies a company that's still executing at a high level. Marvell's data center segment, now a $4.2 billion revenue engine, is growing rapidly and makes up nearly 3/4 of total sales. While Amazon, Marvell's largest hyperscaler client, may be temporarily pulling back on capital spending, Marvell continues to innovate in custom silicon and electro-optic interconnects, both critical for next-generation AI workloads. In fiscal year 2025, the company generated approximately $2 billion in AI revenue, with electro-optics contributing significantly and a growing share from application-specific chips. And here's the kicker. While the company stuck to a $2.5 billion AI revenue target for fiscal year 2026, management strongly hinted that they'll far exceed it, possibly reaching $3.2 billion. At just 6 times forward sales, Marvell trades at a deep discount to peers like Broadcom, which sits closer to 13x. Conservative models still estimate a 16 to 22% upside from here, but that figure could climb much higher if Marvell secures new chip programs or re-accelerates its business with Amazon. In short, Marvell is down, but not out. It's still swinging, still innovating, and still powering a massive share of the AI infrastructure wave. And when sentiment inevitably flips, as it always does, investors may look back at today's valuation and wonder why they didn't act sooner.